When a shareholder exits mid-year, you have two separate tax stories. First, the shareholder reports the stock sale like any other corporate stock sale. Schedule D, proceeds minus basis. Basis is the trap. On the EA exam, they'll test that S-Corp basis changes each year with pass-through income, losses, and distributions. So your gain or loss isn't just what you originally paid. Now the allocation problem. Who gets the year's income or loss when someone sells mid-year? Default rule is per share, per day, basically pro rata over the year. But Section 1377(a)(2) lets the S-Corp elect to treat the year as two short tax years ending on the termination date. That can shift items to the right owner based on what actually happened before and after the sale. To make the 1377(a)(2) election, the corporation attaches a statement to a timely filed original or amended Form 1120-S. The statement explains how the interest terminated, sale, gift, whatever, and it must say the corporation and all affected shareholders consented, including the departing shareholder. Exam tip: the K-1s get labeled. You literally write Section 1377(a)(2) election made at the top of each affected K-1. Quick example. Fairborn Realty has two equal shareholders and a $10,000 loss from January through June. On July 1st, one shareholder sells all shares to a new owner. If the corporation makes the 1377(a)(2) election, that first short year ends June 30th, and the $10,000 loss stays with the original owners. $5,000 each. The buyer gets none if there's no activity after July 1st. Separate from a shareholder exit is a full S termination, when the S election itself ends. Common automatic triggers. The corporation stops qualifying as a small business corporation. It creates a second class of stock. It fails the passive investment income test for 3 straight years while it has accumulated E&P, or the shareholders revoke the election. On the exam, second class of stock often hides inside disproportionate distribution facts. When S status terminates, the corporation usually has 2 short tax years, an S period and then a C period, and items get allocated pro rata between those periods. If shareholders revoke, it takes more than 50% of the shares to do it, so a majority can revoke even if a minority objects. That's a favorite EA exam governance twist. Who has the power to end the election? If the termination was a mistake, you're thinking inadvertent termination relief. Reverend Proc 2022-19 is huge because it gives automatic relief in several common situations, like one class of stock problems, disproportionate distributions, certain Form 2553 errors, missing acceptance letters, and filing an inconsistent return. But some cases still need a private letter ruling, like becoming ineligible because a shareholder turns into a non-resident alien. Also, remember the re-election lockout. Normally, no new S election for 5 years, unless the IRS waives it. Which of the following would be a tax advantage of a multi-member LLC taxed as a partnership over an S corporation? The choices include tax-free liquidation, fewer requirements for boards and meetings, no self-employment tax requirement, or the same liability protection as a C corporation. Think about which one is a real difference in how the entity must operate. The correct answer is fewer requirements for a board, regular meetings, minutes, or other formal administrative structure. Partnerships and LLCs generally have fewer corporate formalities than an S corporation. A tempting wrong choice is the self-employment tax option, because S-Corp owners sometimes reduce SE tax, but it's not no requirement, and it's not a partnership advantage. Which of the following would make a corporation ineligible to elect S corporation status? The options include having a bankruptcy estate shareholder, having a partnership shareholder, having exactly 100 shareholders, or having both voting and non-voting stock. Think about the S-Corp eligibility rules for who can own shares. The correct answer is 1 shareholder is a partnership. Partnerships are not eligible S corporation shareholders. A tempting wrong answer is 100 shareholders, but 100 is allowed. It's exceeding 100, that's the problem. and both voting and non-voting stock is fine, as long as it's still one class of stock for distribution and liquidation rights.